You guys can hear me?
Yep. Gotcha.
That crisp thing and like the noise canceling turns on and off for some reason, but works pretty good. Other than that,
Nice. Let's see here. All right, we had 298 sign up for Madison at Overland Park, so pretty exciting. Almost made it to the 300 mark. Just couldn't sneak in two more.
let's have ourselves a webinar.
Let's do it. All right.
The question is, how many of our attendees are Swifties?
Yeah, and a lot of people like to watch the replay, which everyone will be sending you the replay right after this. So if there's anything you wanted to review, also Mina will be uploading this updated investment summary. I think Mina, if you want to update that one that Nick circulated, if you want to put that in the investor portal, that'd be great.
Yep, we'll get that up right now.
Awesome. Vinny, what's up?
If any of
Sure.
you guys are signed up in our portal, you could, in a couple minutes, go download that and have it open as we go through the webinar at the same time.
Yeah, if you want to send the link, the Lightmark link, if you want to go ahead and put that in the chat too, so people can access that.
Yeah.
All right. We will get this kicked off in 1 minute at 6:05 here. We've got till 7, so let's give you guys 1 minute here. All right, guys, we'll get started. Thank you guys for coming to Elevate's new investment opportunity, Madison at Overland Park. Today, we're going to go over why we like this amazing deal, what we like about the market, tell you a little bit about ourselves, and we'll dig into the underwriting on how this property has been performing and how we expect the property to perform after we take over. So really important things when you're looking at any investment opportunity, and we're here to dive in with that with you guys here today. So you can see just a little glimpse of this amazing property here, 200 unit townhome community. So before we dive into that, we'll talk about the sponsorship team. So joining us on the call is Eric Badiwala, Nick Bowden, and Mina. They are all with Elevate here. So George and Eric are the co-founders of Elevate. Started this, they started in the real estate space quite a bit before Mina, Nick, and myself were really getting started. So they've been in real estate for a combined over 20 years, single family to fix and flip to having a construction company, from that construction company working on apartments to starting owning those apartments. Grew their portfolio from Texas to Arkansas to Oklahoma, South Dakota, Florida, South Carolina, and here more recently, Overland Park, Kansas. So down at the bottom is Tessa and Mike. They run our property management company that we have in-house. To date, we've acquired over 6,800 units. So now more than ever, it is super important to be having good experience. You know, this market is what separates, you know, good operators from not. You know, it's really important to have this kind of team on any project right now if you're going to have success. So really excited to be a part of this team, and you know, we're excited to be able to deliver for you guys as our investors. Joining us on Madison is Chris Salazar and Ben Frazier. So Chris is the founder of Archstone, and him and Aspen Funds here with Ben Frazier, they were the ones that teed up this deal and brought us in to help run point with them on the deal. Ben is actually a partners with us on watercolors. So if you guys are invested, I see some of our watercolors investors on the call with us today. So he was actually one of the main partners there. Their group Aspen Funds, they're local to Kansas City. And Chris Salazar has a very good track record in Iowa and some Midwest areas. And we're excited to have both of these partners here. Rico, who is not on this, is also a local boots on the ground partner that's going to have some oversight there in the Kansas market. So thank you, Tushar and Dharm. Appreciate that. Archstone will be taking the lead on property management. They have in-house property management similar to us. They already have vetted the current property managers, keeping a good amount of them here of the staff. So we feel really good about coming in and having property management under ownership. So we're not using third party here. We like the ability to have that extra bit of control on the deal. So that's a little bit about us and who's going to be running this property. I'll kick it over to Eric to give us a high level investment overview of Madison and Overland Park.
Yeah, thanks, Brian. So, you know, Kansas is one of those markets that we've always wanted to jump into. And I mean, we finally found a good one that we think, you know, it is going to be great for us and great for our investors. You know, we're always looking at different opportunities in different markets, and this is a market that we've had our eyes on for a while. So I want to dive into these details and a little bit of the overview. So, you know, it's a 200 unit townhome. It's in Overland Park, Kansas. So some of you may be familiar with it. Some of you may not be. You know, I have a lot of friends that are from, you know, the Kansas City area. And I said, hey, you know, what is Overland Park compared to? So for those of you that live in like the Dallas-Fort Worth area, it'd be, you know, comparable to like Plano and Legacy West. I mean, this place is really, really nice. I mean, just down the street, you have a ton of, you know, beautiful retail shops, you know, higher end restaurants. I know we had lunch there the last time we were in town. So the area is great. You know, it's got a population of about 200,000 people. And Overland Park is the second largest city in Kansas. So, you know, we're always looking at these metrics when we're looking to dive into a new market. You know, why are people living there? You know, is it a nice place? You know, do you feel safe? These are the types of things that we're looking for. And then Johnson County. So Overland Park is located in Johnson County, which is really a population of about 613,000 people. So it's a pretty big area. But the best thing that we like is, you know, it's the #1 rated school district in the state of Kansas. You know, a lot of families want to live here because of the schools. You know, I know in different parts of the country, that's how, you know, the housing market is dictated by, you know, the schools. And, you know, it's funny, we were just over there doing our due diligence, and everybody talks about how great the schools are there and, you know, why people live in Overland Park. So, you know, we're excited about that. So, you know, the sponsor team, we're just looking to bring rents up to market. You know, we always look for some type of a value add play. I think there's a huge opportunity here with upgrading our amenities. The amenities kind of lack right now at the property compared to some of the other assets in the neighborhood. And, you know, the submarket is great. It's an A+ submarket. I mean, anytime you have the number one rated school district, you know, you're going to have great things in that area with, you know, restaurants and retail. So it's a truly beautiful place. It's, you know, I would live there in a heartbeat, you know, just by touring, you know, the neighborhood. So that's a little bit on, you know, the area. So A+ location. We kind of talked about that a little bit. It's 200 units. The entire complex is nothing but townhomes. This is the only community around there that offers only townhomes, right? So that's another advantage that we have of other communities. I think a couple of the other communities have a couple townhomes, but we have nothing but townhomes, right? So it really plays into that, you know, style of living that people are looking for, right? So if their kids want to go to school there and they can't necessarily buy a house, they're going to come and live in these townhomes. And these townhomes are pretty big. You know, they're 2 stories. They have, you know, basements. They have garages. You know, it's really you know, a family oriented, you know, place, neighborhood, and, you know, plenty of space inside these townhomes. So I was just realizing this, but I guess we like to do big deals. Our project cost here is $50 million. We're looking at a hold period of 3 to 5 years, which is typical for most of our deals. And then, you know, a pretty big equity check. We have $15.5 million of equity to raise. We do have a preferred equity partner on this deal, and they're coming in with a sizable check, and we'll talk about that here in the financial analysis. So, you know, what do the returns look like? I mean, we're looking at an annual return of 22 to 24%. You know, internal rate of return of 17 to 20%, and then an equity multiple of 1.7 to 2x. Typically, when we're modeling out, you know, our deals, we like to give ranges, right? You know, everything is done based on market conditions and where we think we can push rents, et cetera, et cetera. So we like to give ranges, and there's obviously 2 different, in this deal, we have 2 class share types where you can get different returns. And, you know, obviously if you have a little bit of higher of an investment, you'll be getting, you know, a higher split and a higher return. And that's where the class A and class B shares come into. Next slide there, Brian. So target investor returns. So this is, you know, you can either come in with $100,000, and that's our typical investment for most of our deals. But then we want to reward those that, you know, come in with a 500,000 plus investment. And it seems like our last couple of deals, we've had quite a few investors take that, especially with, you know, all the deals we've done this year. You know, our deal in Arkansas and our deal in South Dakota, you know, especially with the return. So, you know, for option 1, I mean, you're going to get a 7% preferred return. It's a 70-30 split, which is very typical. Anything above an 18% return is then a 50-50 split to the LPs and GPs. And for those of you that are new, you know, 70% goes to the LPs and 30% goes to the GPs. You know, and then option 2, if you come in with either $500,000 or more, you're going to get a little bit higher of a preferred return, which is 8%, and you're going to get a higher split, right? So you're getting rewarded for coming in with more money. So you're going to get 80% is going to be owned by you guys, and then 20% will be owned by us. And then anything above a 20% return is split 50-50. So it's the same split, you know, really LP GP, but just a little bit different of a IRR hurdle. So if you look here on the right, you're going to see an average cash on cash return of 4 to 8%, and that's annualized, you know, over the life of the deal. And then, you know, we already talked about the internal rate of return and equity multiple, right? We're always aiming for a 2x equity multiple. So pretty simple, right? For those of you that are kind of confused about all these numbers, I like to keep it simple. What's my money in? What's my money out, right? So if you invest $100,000, you should expect $200,000 back, right? You'll get your back your $100,000 original principal with $100,000 on top of that for a 2x multiple within 3 to 5 years.
Just gonna pause really quick. So we had some questions in the chat. Austin asked a good one. When you're looking to invest, how do you know when the market is overbuilt? Nick did answer that in the chat. I just want to make sure that we have an interactive webinar here, so we definitely will still answer them vocally. Austin, Nick did say that high concession rates, high under construction as a percent of existing supply, and decreasing vacancy are some of the metrics to determine this oversupply. Sometimes you could also look at trade values, looking at cap rates and looking at the price per door that some of these assets are trading at. Usually if you see very high saturation, you'll see very low cap rates and just very high exit prices, which could also indicate such saturation. Elliot asked a question on Archstone. How many units does Archstone have under management, and how many years of property management experience and number of full cycle deals do they have? That's definitely a good question, good due diligence question. Brian, if you could touch on that.
Yeah, Archstone, that's something that, we did coming in with Archstone, and Aspen did a full audit of Archstone's full portfolio, and they were really pleasantly surprised by what they saw. So Elliot, if you want to reach out, we can help share some of that information. They're hitting everything above their targets, which is impressive to say in this kind of market. It's just over 600 units in that portfolio, and we'll be happy to share that. So, and Archstone knows, us as managers, we have the right to remove them as property management, as a group, so, and they're open with that too. They know that if they underperform, that we will take them off as property management and run that in-house. And, we're very open on that, and they're happy to have that provision in there for rights to take them off should we need to. And that's what Joel, our asset manager, will be oversighting. So,
yeah, and just to add to that, Brian, we always look at all of our partners, right? We're getting into a short-term marriage here for 3 to 5 years. So we want to make sure that, we have good quality partners that are going to follow through and that are going to execute, right? So we looked at their current portfolio. All their properties are 90% and above. They have a high concentration of deals in the Iowa market. And their deals are performing, right? So they have their in-house management. Like Brian said, we have the right to remove them, but at the end of the day, we feel that we're experienced operators. We are going to be asset managing this deal together. So there's really no concern there. We have removal rights if we need to, but we feel comfortable with the partnership and moving forward. And, I'm sure there's things that we can learn from Archstone, and, there's things that they can learn from us as well. So we feel that, anytime we're looking at these deals, we got to put together the right partners to be able to execute. And, we feel like we've done that here. It's really about being strategic and having, a good working partner on boots on the ground. And, both Aspen is located in Kansas, and then, Archstone is very close by.
Yep. And our pref partner is also, they're local to Kansas City, 7 Acre. We'll go more into that too. And like Eric mentioned, you find your good partners by having some of the bad partnerships. And, we've had those throughout the years, and where, you come into the deal having a group of partners, and then you are ending up being, maybe the only one standing and the only partner. So definitely have to be very picky about who you're partnering with, now or in any market. So I'll get back to the presentation here, and we'll kind of jump some of these questions I can see being answered actually in the presentation. We'll actually be addressing these on some of these slides. So best school district, Eric mentioned it. Rent to own spread. So again, to that question, we're looking at the numbers here. Something we haven't talked about, we're assuming a 3.9% fixed rate debt. So, bridge loans were all the rage in 21 and, even 22. And, definitely learn that that's not the way to, mitigate risk. So we're coming in and assuming the Fannie Mae debt. So we actually have already assumed Fannie debt before. We did that earlier this year. And it's going to be 3.9% fixed. So we are structuring the deal for 3 to 5 years. And us as partners are incentivized to hit that 3-year mark, but to be conservative, we are holding that 5-year term too. So immediate rent growth, you will see. It's one thing to say you're conservative, but it's another one to actually put that on paper. And Nick, who's, very, very good at his job on the analyst side, can, point to just about any number, and he'll show you exactly why we're conservative here on that rent growth. So we love Overland Park. Eric talked about it. It's kind of like the North Dallas feel. If you're I see some guys from Northwest Arkansas. You guys probably know the Kansas City market and know that Overland Park is a place to be if you're there. It kind of reminds me of an uptown Rogers and in Northwest Arkansas. And these are the kind of stats that you really like to see in a market where you're looking to push rents in a community type apartment where you have, this B class asset in an A class area that has that room to grow. So, if I was living in Kansas City, I would most likely probably be in Overland Park, Kansas. I don't know if that's where Travis Kelsey just bought his home. I don't know if that was in Overland Park or maybe that was in downtown, but maybe could see him there. So rent to versus own spread, talked about that a little bit here. So it costs 53% more to own a home than rent in Madison Overland Park. So 1771 more per month. So that really goes to the case of this movement with us in our portfolio the past 18 months of going after these B and A class assets, where historically we bought a lot of C class, but we're finding metrics like this where you have these people that don't necessarily have the money to buy their first time home, but they still want a really nice place to live. So they're moving into these B and A plus type communities where they're getting very good bang for their buck there. So fixed rate debt, can't say how important that is right now, and we're assuming it 3.9%. Can't really find that anywhere out there, beating inflation with that. So our business plan includes 2.794 in CapEx. This has been adjusted, since we came in on the deal. We will be going hand in hand with Archstone on construction management. They have a construction company. Elevate has a construction company. So Saul, our project lead there, George, Eric, and myself were all on site on the property, walking the property. It's really an amazing property. And Eric talked about it. I was there at 8 a.m. and the school bus actually goes through the whole community. So it's not an apartment complex. You're not really getting a school bus, maybe stop at the front, but the school bus kind of makes its way through the community and picking up kids along each stop. So we really want to make sure they have that, that really community feel, make some touches. And then a big portion of this is we're doing full renovations on 83 of the classic units. So this was built in 1999, finished in 2000. So we have some of these classic units that we can upgrade and get a real big premium to increase the net operating income and really drive the value of this property in the next 3 years. Part of that will be enhancing the curb appeal, some of the amenities. It's got a really nice open feel to it. The community does. So we can add some extra amenities here, upgrade the leasing office and clubhouse, pool amenity that we plan on adding to the current pool area. So a lot of upside here and a lot of value to be added.
Yeah, and just so everybody knows, so the current owner, we have 200 units here. The current owner has renovated, what's that math? 200 minus 83, 117 units already, right? So they've come in and proved this business plan, and we're coming in and continuing it, but we're going to actually take it a step up nicer, right? So they've come in and put in like granite countertops. We're coming in and putting quartz. Right, we're going to modernize these interiors a little bit nicer, come with a little bit more modern furniture, at least in the models. Corporate units is never out of the question. That's something we normally test once we own and operate the property. But these units flow very well. Like I said a little bit earlier, they're 2 stories. They have basements. They have living areas. The rooms are very big. The closets are big. Fully equipped kitchens. They have fireplaces. Again, this is where families are living, right? They're making this their home, and they're putting up Christmas trees and stuff like that. Not that you don't put up a Christmas tree in an apartment, but you just have more room here, with some of these units. So right now, the current owner is only doing, again, I said we're going to take it up another notch. So they're doing granite countertops only. We're going to come in and do quartz counters. They're only doing black appliances. We're going to come in and do stainless steel. So when we come into an asset, we always talk to the current management company, and we ask them like, hey, what is it that people want here? What is it that people have requested over the years? And they said, look, if you put in stainless steel appliances here, people will pay more for that because it's nicer and it gives it a more luxurious look, right? So, especially with, stainless steel and that's really just almost in any market, you can always get a premium for your black or stainless steel appliances. So we'll come in and put, some newer vinyl plank flooring in. There's some units where the old owner upgraded the unit, but didn't put, vinyl plank in the living room. So it still looks a little bit, classic. So, upgrading those areas is going to be, a plus for us. Some of these basements, they're very plain. It's really like a second living area, if you want to call it, but we need to spruce those up, right? There's so much potential in these basement areas to upgrade. And then forgot to mention this, but each unit has a washer and dryer as well, and that's down there in the basement. So we'll be painting these units, new fixtures, new lighting, porch counters, stainless steel appliances, and making them look nice, right? This is a B+ asset in an A+ community, and people are looking for a nice place to live. So we're excited about renovating these interiors and changing them, right? And making it just a little bit nicer for all these residents. On the next slide, we'll talk about some of the exteriors. The exterior actually looks pretty good. Our focus is really going to be upgrading the amenities, like I talked about in the beginning. The amenities is something that, look, when people live in an apartment, they want you to, provide a good quality of life for them. I think right now we have a pool, there's a playground that needs a little bit of work. There is like a, picnic area that is really hurting. If you look at it, it's very plain. It's got some blue benches and, some old, charcoal grills. There's no grill at the pool, right? There's no place to hang out like during the summer and grill out. Every apartment building has a grill. You wonder why it's, why they never put one in there. So you might think these things are, super simple, but they're simple changes that, will cause people to pay more rent, right? As long as they feel like, hey, you're kind of elevating my life here a little bit. They're willing to pay more. We're going to put a fire pit out there. We're actually working with a designer now to create a splash pad right next to the pool area, right? There's like a parking lot right next to the pool where the use of the space isn't very good, and we're thinking about putting a splash pad there because there are a lot of kids, there are a lot of families there. So some of the upgrades that we're going to be doing, right? And I talked about that picnic area just needs nicer benches, better lighting, just create a little bit better of an ambiance. Landscaping is part of it. We need to spruce up the landscaping a little bit. We'll be doing some work to the irrigation system, and then power washing the brick, on all the buildings. Stucco was recently painted in 2021. And, for the most part, the exterior looks good. It's really going to be a focus on the amenities. Kind of talked about this already, amenities. Actually, a couple things that I missed, we're thinking about adding a pickleball court, new pool furniture, sprucing up that playground, putting a little bit more of like, rubber mulch, and then upgrading the clubhouse. The clubhouse doesn't really have much right now. A lot of people walk in and say, hey, can I rent this space? And there's not really rentable space there. So we're thinking about taking one of the model units, because we don't necessarily need 2 model units, and converting it into a space where you can rent. So, right. So some ideas that, we've been floating around and they're in the business plan so that we can, again, offer to the residents. And a lot of times we come in with this business plan and we like to stick to the business plan, but sometimes these things change, right? So we'll alter it based on a little bit about what we hear once we're able to take a resident survey once we own the property. But these are the things that we feel that will add the most value right now from a high level and, from the due diligence that we've done. What's we got? All right, market overview. I think Brian's going to take this one since he's a lot closer and knows this Kansas area, and then we'll chime in here.
Really quick, just want to pause you there, answer a couple more questions. We've got a lot of questions coming in. Some of you guys' questions are financial questions. On the financial questions, we'll answer those towards the end. We have a whole section based on the pro forma where Nick will go through our analysis and all the numbers and why the financials are the way they are. Some good questions about why the current owner is selling. We just told you guys they started implementing basically the business plan we want to implement. Why did they start doing that, and why are they now deciding to sell? Nick will touch upon that right now.
Yeah, I mean, the current owners selling, they're a Pennsylvania-based company. And this is really their only asset in Kansas City, so it's kind of a lone duck in that way, and they're ready to offload it off their portfolio. They've got over 6,000 units on their own, and so this is really a low priority asset. And they really just want to divest of it and then focus on their core assets in other markets.
And then Misty, we'll answer your question about our history on full cycle deals towards the end. Once we start going through our portal, we can touch upon that really quick for you, and we can continue.
Okay, yeah, sounds good. I think there was another question that came in. Someone share how much investors at watercolors make quarterly and the projection at the end of year 5. So we actually, watercolors was a little bit different here. We closed phase 1 and 2 in January, and then we just closed phase 3 in June. So phase 1 and 2, we bought occupied, and phase 3 actually had 0 people in it. So when we took it over, we knew we were going to have to lease up 144 units. So that one was a different business plan than Overland Park here, where we already have existing. So that one's going to be a little bit different, but we have started quarterly distributions there. This one is not so much of a cash flow, which we'll go into more and more on the upside there.
Yeah, I typed out an answer there too, Brian. It's just a different dynamic, like you mentioned. Here, it's a little more straightforward. You don't have new units coming online like we do over at watercolors. So,
yeah, and we just bought that. We're from phase 3. We're only four months in, so it's a 5-year plan, and we feel good about that. We've been doing distributions on that one, and a little bit setback on not getting them leased up as fast as we'd like to, but we already are making, that's a good performing property, but we want it to be performing amazingly. So we're already making changes on the property management side. So we're just now in the process of switching property management companies to really ramp that up and to get a better feel for that. So that's something that we do on all our assets, and we continually monitor them. Someone asked about average returns in the chat. Historically been average 33%. We've exited about 1,800 deals. We've had, we're very bullish on the A class. We've had some challenges with some C class properties that had floating rate debt on that, but we've never lost any investors' money. We're still working through some of those, and our average IRR historically on exited deals has been over 33%. So real estate market, those were good sales, and still believe in the long-term value. So let's see. What percentage of the apartments are currently rented? I think Nick will be going into that on the analysts, and we'll also show how conservatively we have that to go over. So, vacancies, to someone put in there, how are you accounting for vacancies? We actually have on our underwriting 10% vacancy. We're actually projecting the vacancy to go up, and we're also projecting a loss to lease. So increasing rents, but also having a increased loss to lease for having concessions. Feel very good about those numbers, which Nick will go in. So back to our scheduled presentation here. The questions are amazing, so keep those coming in. We'll address some of those as they come, and some of those at the end. We really like Kansas City. Eric mentioned it's been on a radar for 3 to 4 years now, and Kansas City is about 3 hours north of me here in Northwest Arkansas. It's a really growing area. A lot of us are hearing about it right now, but a lot of the Swifties, Taylor Swift and Travis Kelce, that's all over the news right now. So that's probably going to add quite some impact there. We're not accounting for any of that, but I think her Taylor Swift tour had like $1 billion of economic impact to the U.S. across the U.S. So pretty amazing to see that. But we like Kansas City, not just because of that, but because of the dynamics and because of its growth. And right here, it's on the top 10 list of a lot of reports that you'd like to see in places you're moving to. So it's a very business friendly and landlord friendly area, especially in the county that we're investing in. Now, in big cities, that can change county to county, no matter where you're at. You know, with a big city, that there's dynamics and change. But in Overland Park, the average time to evict is 30 to 45 days or less on that. So, you know, that is friendly for the landlord if someone's not paying rent there. It's the best city, Overland Park, best city to raise a family, number 5, top 100 best places to live, best city for young professionals, best place to start a career. So these kind of numbers you see, you know, these young professionals, best place to start a career. That's what creates a stickiness to a market. You know, looking at population growth is great, but to sustain that population growth and job growth, this is what you like to see. Hottest US job market, remote workers, having the best place to live, that will sustain that market growth and population growth. So incredible top 10 things here to see in the market. Kansas City has, you know, over 2 million in population. So it's on a lot of institutional radar. So, you know, Elevate is investing in more tertiary markets, Rapid City, South Dakota, Northwest Arkansas is still considered that, some areas in Oklahoma. But this really plays for a good exit. When we're selling in 3 to 5 years, who's going to be our end buyer? You know, who's going to come in and buy this from us? And that's some of those institutional buyers. Best school district, right here, number 1 in Kansas and number 75 in the US. So really great place to raise a family. And those are the kind of communities that we want to be in on these B and A class assets.
Yeah, and just to add to that real quick, Brian, if you look at any Google Maps, well, any Google Maps, just Google Maps in general, you'll see that we're right by a golf course. There's an urban air trampoline park. You have a couple senior living communities around here. I mean, it's a very upscale type area. I mean, the restaurant we ate at, I mean, I don't know, it was pretty upscale for just a lunch meeting. You know, but it gives you a very high-end feel. So I would encourage all of you guys that are, you know, have never maybe visited the area, just go onto Google Maps and check it out. I mean, you'll see a ton of restaurants, a ton of businesses, orthodontist office, chiropractic offices. You know, the area it speaks for itself. You know, and when you drive in there, it's a completely different feel. You know, and again, we always say in real estate, it's all about location, and you know, we feel we really hit it on this one with where we're at.
So we're making a $50 million investment into Overland Park, Kansas, and we're not the only ones making investments in the area. Tesla, there's a Tesla facility. Actually, that investment is being made by Panasonic to build batteries for Tesla. That's a $4 billion investment. That's a huge investment by Panasonic into the area, and they're already shipping in employees from not national but international employees from Japan. They're expecting 300 a month to be coming into the area to start opening up this facility. Really good trajectory for it. New Century is a 4,200 permanent job in Johnson County. Welski expands 1,000 new jobs in the area. And so you can see on this map too here, T-Mobile corporate, so Sprint, they are also making a $400 million or $70 million expansion to their headquarters there. So another big group that is making investment in the Kansas City market. Right here you can see Garmin, United Health Group, a wide range of employers here. So I think some people think, you know, Kansas, Oklahoma, Missouri, they think oil. I guess it just depends on what part of the country you are, but you can see here, this is, you know, an energy company, or, you know, the battery plant, WellSky, New Century, T-Mobile, Garmin. It's a very wide range of employers. So that really helps mitigate your risk in any kind of economic factors. You know, if the oil industry or the tech industry or the healthcare industry one industry or the other gets hurt, you have these other industries to support it. So it's not just a one-legged industry area. You can see right here, these nearby employers. And when you see these large corporations making investments into an area, that's a really good sign that, you're making a good decision, making an investment in the area too, because these guys aren't just throwing up locations anywhere, like a Dollar General, you'll see Dollar Generals anywhere on the side of the street, but these companies are making calculated investments and into this area. So one of the more important parts of the deal and how this shakes out to you as an investor is the financial analysis. So I will hand that over to our director of analysis and acquisitions, Nick. He's on the call with us now. So we'll get started here on, this is the current unit mix with their rents and pro formas. Looks like Nick's screen might actually be frozen. Thought he was leaning over and looking at oh, we got you.
Yes, he's back. We can't hear you though, Nick.
Back from the dead.
Can you hear me?
Yeah.
There we go. We can hear you now.
All right, cool. Yeah, so first slide here, looking at the unit mix, the total average pro forma rents that we're targeting here is $20.95 chunk rent, $1.13 a square foot. And really the interesting part about this property is the size of these units. They're townhome style, 1,420 square feet across the board. So while our chunk rent, it's reaching $2,000, our per square foot's pretty low at $1.13. And also, like we previously mentioned, there's a nice spread between the rent to own percentages there. So just want to talk about where are rents today, where's occupancy today, what does it kind of look like over the past 12 months? So looking back over the past 12 months, this property has averaged 5.5% vacancy, so basically 95% occupancy, while pushing rents $93 across the board. So that's really great to see. They're executing this value add plan while keeping vacancy very high. And we're actually underwriting for the next 12 months a 10% vacancy factor with similar pushes on the rents, reaching our pro forma rents by year 3. So that's one conservative metric that we're looking at in that sense. And for concessions and bad debt, those have been historically very low. Bad debt has been effectively zero as they recovered 20 bips of bad debt over the T12 period and only wrote off 15 bips. And then the concessions have remained very low as well at 20 bips over the T12 period. So all across, looking at historicals on this property, it's performed very well and is in line with what we're projecting over the next 12 months and for the rest of the business plan. And as far as affordability for the rest of the deal cycle, because we'll talk about it in a bit, but a big part of this deal is the refinance and then potentially the sale in year 3. Like how are rents looking there? What does affordability look like at those periods? And the key metric that I'm looking at here is the median household income in this area. It's over 100,000 on a 1 mile radius, and on a 3 mile radius, it's over 120,000. And based on our pro forma rents, we're going to stay well below that 30% rent to income threshold that we like to stay in line with or below in this instance. So that's definitely getting us comfortable with how we're pushing rents here. Let's go to the next slide. Oh, wow, we jumped around quite a bit. All right, yeah, I can talk about this one real quick. Based on the September 19th rent roll, we
Did we lose him again?
Yeah, we did. So here you can see, I'll take over until he comes back in. So, talk again about conservative underwriting. Right here, you can see that on our projections, we actually have, we're lower than what the actual rents are getting. So we're using, yes, it's good to look at these comparables for other properties, but being able to self-comp is one of the most powerful things you can do. It's looking at your own already renovated units. So we can point to those and say this renovated unit on site on the property, someone is already paying this. So our pro forma rents, we actually have it just under that, just to be conservative on our as we move through these upgrades.
Yeah, we have several that are ready at the pro forma rents, and those are the ones that are even higher than the pro forma rent.
Yeah, you can see that right here. So these rents are actually higher than what we're pro formaing. Looks like
Nick, are you back?
Yeah, sorry. I don't know if I was just talking to myself for the past 10 minutes or what. My internet is just all over the place, guys. Sorry about that. So I guess we've already talked about the pro forma rents and how we've already reached those on several units, right?
Yep.
Cool.
You did have somebody asking about the cost, what we're paying. So this is probably a good one here.
Yeah. I mean, purchase price on a per square foot basis, it's only 156 per square foot. And total project cost when you factor in all the CapEx and other things, we're reaching 179 per square foot. And recent sale comps, they're pushing above 220 bucks per square foot. So good to see a spread there on the project cost versus where comps are trading recently. And another factor or another metric that we're looking at here that we like a lot is, we're not buying this thing at the best cap rate, but based on this value add strategy that we're very confident in and has already, been executed on several units, we're going to trend this thing up to a 6.9 yield by year 3, which gives us a nice spread on our exit cap that we're assuming. So that's one other metric that we're looking at as well. All right. Talking about, the disposition data here. We've got recent sale comps pushing up to 222 per square foot. And we're underwriting year 3, 234 per square foot exit, and year 5, 249 per square foot. And exit caps that we're assuming, we've done a lot of sensitivity analysis on the exit caps because that can make or break your deal. We're currently assuming a 5.25 exit cap here. But what we really like is the recent trades over the past 12 months. We're averaging close to a 4.5, 4.75 exit cap. And, by the time we're looking at a year 3 or year 5 exit, based on SOFR curves, based on the timing of this thing, we feel that the 5.25 exit cap, which is above where recent trades have been, is a very compelling argument for where this thing will trade in the future. And that gets you these returns below 16 IRR to the LP and a 19 on a 3-year exit. Yeah, these are just some of the sale comps that we were discussing earlier. So the average comp set trade price per unit is $249 per unit. And the average price per square foot is $222. We're purchasing the asset for $221 per unit, below the comp set per unit average, and also well below on a per square foot basis. So regarding the
I think we lost him again, George, if you want to jump back and discuss sources and uses.
9% rate.
Oh, you're back. So you got cut off right when we started on here. So
Okay.
you can start fresh.
All right. Yeah, so for the sources and uses, we've got the senior loan that we're assuming, agency debt at a 3.9 fixed. And that gives us a 3-year window to execute our strategy at fixed rate debt. So there's no risk of floating rate there. And then we're bringing in the preferred equity partner as well for a $12 million check, bringing up the total leverage to roughly 71% LTC. And it's a local Kansas City group that's providing it. They like the asset. They know the market very well, and they're going to be a good partner with us on this deal. The terms of the preferred equity includes a 14% total pay, an 8% current pay, and a 6% accrual, and a 5. And we conservative reserves on this thing as well, as far as interest reserves and working capital. And yeah, so the total capitalization of $50 million, that brings us on a per unit of 253, which is just above where the trade average is on a comp basis as well.
Yeah, I think that really speaks to the strength of this deal is having a preferred equity group bring a $12 million check, that they feel very confident and know something that they feel that $12 million is well put. And another reason I think that really stands a testament to the deal is 7 Acre, our pref partner on this, they're local to Kansas City. So it's not some outside group that is coming to look and make a large investment into an area. It's not someone out of California or the East Coast. It's someone who knows the market intimately. They have other assets in the area. So knowing the market, they're ready to put that kind of an investment in the deal. So Misty, that question, who and what is, so 7 Acre is the name of the preferred equity. And they are, so preferred equity, they come in and similar to our investors, they're coming in and writing an equity check, but they structure that by just getting a higher pref. So they have large funds, whether that's their family office or investors, and they are more worried about just preservation of capital. Now, us as investors, preservation of capital is top of mind for us, but we also like to see upside. So they'll come in and they'll get a higher preferred return, but will not participate in the upside of the deal. And they'll come in and have, they'll be coterminous with us as investors too. So they're coming in, when we're assuming this loan with Fannie, they're coming in and they're basically partners and investors in their mind. So, and we like using, we're very, there's a lot, there's some groups out there, and we're very particular about which groups we will use and which ones we're putting on the deal. And we feel really good about this relationship with 7 Acre moving forward too. So here's the 5-year pro forma.
Yeah, I mean, on the 5-year pro forma here, we're projecting our year 1 NOI of 2.1 million, which is actually pretty much in line with what they did on the T12 basis. And it's really because we're giving ourselves a conservative vacancy factor of 10% that first year and a lot of loss to lease to execute this value add plan. We're bumping up, on the expense side, I can talk to that a bit. We're bumping up property taxes, assuming 100% of purchase price reassessment there. Insurance, we're looking to get that down actually below pro forma figures, but we feel good about that 211 first year premium. And then as far as other expenses, we're bumping those 2 to 3% from the T12 figures, except for payroll. We've reduced that a bit because we noticed there's an overstaffing of roughly 1 employee at the property, so we're going to reduce that a little bit. But as far as other expenses, we're pretty much in line with existing operations, and then factoring in a conservative tax assessment.
really quick, Nick, while we're on pro forma, can you just discuss the different scenarios between year 3 and year 5, whether we're going to refinance or sell? And on the refinance, what interest rate are we assuming there? What cap rate and interest rate are we assuming that we're going to enter into there, year 3?
Yeah, so year 3, as far as the refinance, we've plugged in for this model a 6% interest rate, a cap rate valuation of 6% at refi, LTV of 65%. And, it sizes to a 128 DSCR under those assumptions, and our pro forma NOI of $291K per month, and debt service of 227. So a 128 DSCR ratio, which is a pretty healthy, that's going to check the box as far as refinance. That's, who's to say that rates might not come a little bit lower in the future, 3 years from now. And maybe we can get some more proceeds and generate some higher returns in a year 3 refinance. But that's, we feel good about that refinance test right here, with the ability to pay off the existing senior debt and the preferred equity partner at that point in full, plus a return of capital to the common equity.
Yeah, and you can see on this slide where we really, are stress testing the deal based off our current projections, and where we think where the market will be in 3 years. I think we'll be in a good spot in 3 years, but nothing is guaranteed. So here we also put in a 5-year projection. I still think the market is still going to be not a really good time to sell for the next 1 year, at least not the next year, maybe not even the next 2 years, but tail end, coming into 3 years, I think we'll be in a good spot, and especially 5 years. But obviously no one has a crystal ball, so we try to test different scenarios. If the market does loosen up here, you can see how that shakes out to you as a limited partner, and how it shakes out to the assumptions on the exit price. So yeah, that's what this one right here too is. So all that underwriting is what goes into what net, the cost of the deal, our underwriting assumptions, and what that shakes out to you as an investor. So for us personally, I'm putting money in this deal. I put at least a minimum as an LP in every single deal that we're putting in. So as a GP team, George put it in the chat, we'll be putting at least 10%, which is a requirement from our lender too. So we'll have over $1 million in the deal as well, and that's on the GP side. And I like to invest on the LP side, just from the passive, the depreciation benefits and having that extra income coming through. So as the investors, you are getting the majority of the upside. So here you'll see 7% preferred return, and that hurdle, we have a large hurdle here at the 18% mark. So it's really incentivizing for us as general partners to come in and hit the deal out of the park, and achieve that 18%, so we can participate more on the upside with you. So here we have just over 22, just about 22% average annual return on the 3-year hold, and about 20% average annual return on the 5-year hold, doubling your money in 5 years. But again, as I mentioned, us as a general partners, we're really incentivized to execute our business plan in 3 years, so we can participate more on the upside. But should the market not be in a favorable place to sell in year 3, we have that refinance taken out and holding for another 2 years. So with this deal, what we are having, we're putting $2 million into it, and having a lot of value to be added in that first year. I think Nick showed on here. I'm not sure if it's on here. I wanted to go back real quick because it kind of got lost in the shuffle, I think. But we have 18% loss to lease. and a 10% vacancy loss in this first year, 1 and 2. Now, we very well may not hit that, but those are very conservative. No, that's a 28% total loss there. As we're increasing these rents, adding concessions, and then expecting people to move out based on the current numbers. So, yes, the cash flow is lower on this one, but really the value to be had here is in that, shorter term, 3 to 5 year, and capturing that upside really in year 3. That's for our $100,000 investors. And then for our $500,000 investors, a little bit incentivized here. We have an 8% preferred return. And then the investor hurdle is not until we achieve a 20%. So higher incentives here. On the $500,000 investments, we always have several $500,000 to $1 million investors on these deals, and like to offer that extra incentive there. So I saw in the chat, completed cost segregation yet? Yes, we did. Madison Specs does the cost segregation. So for every $100,000, we're expecting to receive $40,000 in 2023 bonus depreciation, and then $71,000 spread out through the life of that. We are opening this up now. Like we mentioned, we have the preferred equity partner. We have quite a bit of commitments just from the initial outreach. We'll be closing this December 20th, and we would like to get funds in this coming month before then, so we can be set to close. And this is going to be our last deal of 2023, and I really do not think this one is going to last long based on the kind of commits that we've had. I know Aspen Funds is working on a $8 million investment, which will take a large chunk of that out. And then, with the amount of interest here for people still trying to get in on the 2023 bonus depreciation, this being our last deal of the year to place something in this calendar year, don't expect it to be out there long. So definitely want you to get very comfortable with our assumptions here, our business plan. But once you do feel comfortable, we definitely encourage you to, make that investment in your future. So after closing, we'll be sending monthly updates at the end of the month. We'll send your K1s, which will include this depreciation at the beginning of the year, and we'll be available 24/7 for any questions. You can always email us. We're very quick to respond. We like to make ourselves available for you guys because you're the ones putting your hard-earned money into these deals. I will show you guys real quick. We're right over on the time, so I would like to take you guys through our investor portal here. I think Mina put it in the link, but you can go to Elevate. Actually, there's a new link, huh, Mina? What is that?
Yeah, so
elevatecig.com/invest-Madison.
Yep.
So you'll go here, put in your name, phone number, residency. I'm looking to invest however much you're looking to invest in the future, maybe not necessarily this deal. And if you're an accredited investor, so this is for only accredited investors. So that means either you're making a $200,000 yourself or $300,000 income between you and your spouse, or a net worth of $1 million. A lot of our investors are hitting that on the income level. And then, so this, you'll get verified. There's a couple ways to get verified in our portal. If you know that you're an accredited investor, I would encourage you to sign up and then work through the accreditation before we finalize that. So because I already have a investor portal, I will go ahead and log in here. And this is the portal that you'll see. So these are all my, like I mentioned, I'm personally investing in every single deal that we put out. So it's a really very investor friendly. This is my actual limited partner investor portal, different from my general partner investor portal. This will show you all the deals that you've invested in. It'll show you your portfolio. So as you build your portfolio with us, you can go through there, and this is where we'll send monthly updates, distributions on investments that are able to. So for Madison and Overland Park, you'll see this right here. Click invest. I've confirmed. So the investor paperwork is not up, so that will be up by next week. But you can go ahead and make your reservation now. So investor A class is for 100,000, B class is for anything 500,000 and above. So you'll go here and put that investment in. Yes. So there's no e-sign documents yet, but this is where you'll be able to see the PPM and the OA going into detail, everything that we talked about, how you're treated as a limited partner, and everything about the deal. You'll want to review those and then sign those. And then here, you'll want to take a screenshot with your phone. And this will show you where you'll be able to send your wire to. So most banks will have that in person. And then you can put your date when you plan on sending those funds, and then submit, and that'll lock you in for your reservation. So this will show that I am now committed for 100,000 and I've got my reservation there. So we can go back through here real quick. We are over. I do appreciate you guys' time today. So definitely email us for any questions you may have not gotten here, but I'm going to go ahead and, for those of you that want to stick around, we'll go ahead and answer some of these questions that weren't answered. Do you accept the accreditation? Yeah, parallel markets is a very good one. The accreditations are actually good for 5 years per the SEC, and you can send those as long as there's been no substantial changes in your income or net worth.
You can, sorry, go ahead, Brian.
Parallel markets is one that we recommend, and then you can also send a letter from your CPA, which is in the portal.
And everybody, you guys can, in the portal, you'll see the OM, basically the document we just went through. I dropped my email in the chat. You guys feel free to reach out whenever. I can email you the OM, answer any questions you have, and we could also get on a call and talk through whatever you need to discuss. Yes, 401k funds are all right. A lot of our investors do that. A lot of our investors use self-directed IRAs and whatnot. So yes, totally okay.
Yeah, non-accredited investors, we do have the debt fund open that is converting to a C. So that is available if you are non-accredited. If you can depreciate if you don't own any rental property. So if you're not a real estate professional, it really depends on your CPA for these benefits. If you don't participate, if you don't use them in 2023, you can roll those until we sell, and then that'll mitigate your capital gains there. But again, you will want to talk to your CPA. I recommend trying to become a real estate professional or having your spouse qualify as a real estate professional to maximize your tax benefits and get other incentives, home office, writing off cars and miles. And you could talk to your CPA about that. But we do have, practicing physicians that invest with us that are able to capture this depreciation. So really want to get a CPA that invests in real estate. Percentage of funds are already raised at this point. So based on, so we have about $15 million total raise outside of the pref equity. If you're including the pref equity, that percentage is quite a bit higher. So you minus that 8,000 or 8 million plus 3 million. We've got quite a bit of commits. I would say, close to 60 or 70% is committed at this time. So, but we don't have the syndication documents up yet. Those will be up next week. So it'll be first come, first serve. You'll want to make your reservations, which will help lock you in. And then once we have the documents, it's first to whoever sends those final wires.
Question about distributions. Generally speaking, we do quarterly distributions after the first 6 months, but for this deal, we can expect that to maybe be a little bit later, depending on, the value add play and how long that takes and whatnot. That's usually generally expected in deals like this, where you're doing value adding, you're spending a lot of money on construction and whatnot, while you boost up your NOI, and then you could start distributing. So again, really the big play is getting in there, hitting our plan quickly and efficiently, and then giving you guys a good equity multiple towards the end. I know Eric discussed that in the beginning, and so did Brian a little bit.
Yep. Fees are on on the financial analysis slide, and in your investor projections are net of those fees. We are yes. So when it's supposed to close, this is closing December 20th. So that's when we have till. We would like to have all our equity and be able to close before then, but that's the time that we've given to assume. So it is a Fannie Mae assumption loan. So we will be closing, we really are pushing this to close before the end of the year, and before Christmas, to be able to capture bonus depreciation and lock in that really nice debt on the property. So this will be the last deal that we do for this year, and we're really excited to be doing it. Yes, the depreciation amount will be reflected. You'll be in the tax document. That's what you called a K1. So that will be on your K1 there.
Yep. And Melanie, December 20th is when we expect to close. So definitely trying to get funds by the end of November. Towards the end of the year, it starts getting hectic with holidays. Everybody's traveling and whatnot. And so we definitely want to try and close that as quick as possible, and close this year.
Yeah, I would say if you're comfortable, I would make your reservation as quickly as possible, and then plan on sending your funds after Thanksgiving.
And let's everybody definitely try and jump on a call with me. I can run you through everything, answer all your questions, and try and help you navigate through the process.
Yeah, do you want to put your call link in the chat there?
Yeah. I'll do my email and my number. Please call me, text me, whatever you are most comfortable with, or email, whatever you guys want to do.
Well, this is really good, guy. I mean, this is one of the more questions that we've gotten in more recent times. So that definitely is a good sign. I'm glad you guys are engaged. It sounds like we've got some experienced investors on this call too. So I'm really excited to see this kind of engagement on the call, and I'm glad we can be open and answer these questions. We try to be as transparent as possible, good or bad. Real estate. We like real estate for the long term, and like the stability. It can have its ups and downs. Not quite the roller coaster of the stock market. Which is why we like real estate and bullish on it. So, but we're happy to be here and answer anything for you guys. So,
and just to note again, fees are not, Brian already said it, fees are included in your return. So fees are calculated with the net returns to you. Depreciation is not. So that's another little bonus. We do not calculate depreciation in you guys' net returns. So that's another little bonus on top of the returns we're already projecting.
Yeah, that's a good point, Mina. We have a lot of investors that some of them don't even care about 2xing their money, right? They just want to figure out how to keep more money in their pocket, So I think when you're talking about the benefits of multifamily in general, not only are you getting a safe vehicle to 2x your investment over 3 to 5 years, you're figuring out a way to pay less money to the IRS. So definitely two different things there, but that's why it's almost a double dip when you're thinking about this. We have quite a few investors that, like I said, they just want to invest just for the depreciation alone. So this one will be kicking back some pretty good depreciation over the next couple of years.
Awesome, guys. Well, we're really excited to get in on this awesome community market and opportunity with you guys. We're partners in this deal, limited partners and general partners. So really appreciate everyone's time. If you guys missed the link George put it in the chat there. If you are on this webinar, you'll automatically get emailed the replay, and you can always email Mina or info@elevatecig.com, or one of us will pick it up. So everyone have a good Thursday night and good finish to the week, and we're excited to be investing with you guys.
All right, good night, everybody.